Good morning, everybody. How wonderful to see a crowd like this here in my adopted hometown, New York. When I walked in this morning, there was a guy taking a picture of New York, and he said, "My God, this is one of the most beautiful cities in the world." And I was thinking, isn't that a nice realization, right? When you live in a city and you're like in the city, you never really realize how beautiful it is. And this is a great spot to see New York at its best. I was just asking my friends AI, compare it to countries. It says it's a 2 trillion economy, and it compares to the whole of Italy and Canada. That gives you an idea how powerful that view is that you see here. But I'm not the reason why we're on the stage here. I'm here to introduce our chief economist here in the Americas, Porek Harvey. Porek, come and join me. We're going to try and make this as interactive as possible. Porek often goes with us to see asset managers and other banks and other financial institutions, and he really, really likes to have it interactive. And I like it to be interactive as well. So we're going to have a couple of polling questions. He's going to have it like a general introduction. But we thought maybe it's a good idea that I quickly walk the room and see if there's any specific questions or observations on your mind. And those that know me know that I can choose people, or you can put up your hand. So maybe put up your hand, or... Why are they so shy, John? What's on your mind when it comes to macroeconomy?
Well, as a, let's say, 30-year banker and now involved in cross-border space, especially in real-time payments, financial inclusion comes to mind, and how money movement encompasses, let's say, payment flows. I'm also, just want to say, from a Basel III perspective, and pointing out how banks today apply capital and some of the challenges as to how to really, consider trade finance as a viable way still of financing, but when you really don't get the relief that traditionally you used to receive, how is that going to affect money movement, especially with supply chains becoming so, let's just say, extensive. So, thanks.
So I don't know if Porek can talk about trade and payments in detail, but he's definitely going to address GDP and how that translates into the economy. Any other questions that's on your mind? There's a question. Andrea.
Thank you. I'd like to hear about Africa and how it fits into the supply chains globally, whether from a natural resources or other perspective.
That's a topic close to my heart. That's my home country. Anybody else with a question that they would like to know or address? There we go.
Good morning. We're 9+ months into the administration's trade policy. What is the outlook?
He can definitely talk to tariffs, right? So one more person with a question or a FX. Anybody interested in FX? I am. There's another question. In FX, he's interested. No, good. So, Porek, then I might hand it off to you there, because I know that you have a strong view on FX. And give us a little bit of lay of the land, and then we can get to the polling questions after that.
Yeah, thanks, Nick. It sounds like you're in wine tasting mode there. Usually when he speaks like this, I'm expecting to see wine appear, and he's going to give us a big talk about South African Sauvignon, whatever the hell it is over there. No, thanks for that. Yeah, but you've really set me up here with some tough asks. Thanks for that. So I am going to try and address some of these questions, but I want to start off talking about the administration a bit, and I'm just going to go back about a week ago. Donald Trump, our president, was posed a question. What do you think of the dollar? Are you okay with the dollar weakening? And he basically said, love it. Now, that is not what he actually said, but it's what he meant. This is an important backstory. You've got to remember that President Trump was a big hitter back in the 70s and 80s across the Hudson here in New York City. And one of the things that really irritated him was the avalanche of inflow of Japanese electronics. And you fast forward to today, and he's irritated by the Japanese cars on the street. So that's our president. That's where he is. But the point is, there is a silent acceptance that the dollar it's okay if it depreciates. Now let me give you some examples. I'm going to talk about three crosses here. I'm going to talk about the Japanese yen, the euro, and the Chinese renminbi. So the big story over the past couple of weeks was the Japanese yen. Now, the thing is, if you look at Japan, you've got US rates up here, you've got Japanese rates down here. There's about a 400 basis point difference between US rates and Japanese rates. Now, if that's the case, if that's an equilibrium, this currency, this Japanese yen, must appreciate. If it doesn't appreciate, you don't have an equilibrium. And clearly we haven't had an equilibrium. This spread is too wide. So what we've seen is the Japanese yen come under tremendous weakening pressure, and subsequently Japanese rates under tremendous rising pressure to tighten that spread. CNH has been quite different. By the way, the backstory here is, will the Bank of Japan intervene? So far, they haven't. If they do, our view is that dollar yen gets back down to the 140s. It's currently in the 150s, high 150s. CNH, different story. And this is where there's a bit of a nuance vis-a-vis President Trump's story. The PBOC in China has an ambition to keep that exchange rate versus the dollar as stable as possible. Because the medium-term ambition is for the renminbi to be in competition with the dollar, potentially as a reserve currency. And they've been very successful. So while the yen was doing what it was doing, the CNH, in fact, was very stable. And our view on the CNH is that it remains around 7. So it's currently just below 7 versus the dollar. We think it can trade a range between 685 to 725. And if that's the outcome, that's a very stable outcome. And the pressure, in fact, for CNH is towards appreciation, not depreciation. So President Trump shouldn't worry about the CNH. Let's go to euro dollar. So again, let's ask the same question. If I was to pose a question to this audience, in the normal scheme of things, what would you normally expect? Would you expect dollar rates to be above or below euro rates? Well, of course, above euro rates. That's been the historical context over the past number of decades. And typically, dollar rates would be above euro rates by 1%, 2%. If you think of the Fed versus the ECB, or SOFR versus Ester. Now, if that's the accepted outcome, and I think it is, again, the currency of the lower interest rate environment must appreciate. If it doesn't appreciate, you don't have an equilibrium. By the way, this works in real rate space as well. You'd be surprised. US inflation historically has averaged 2.5%. European inflation, 2%. So there's a real rate differential as well. If you talk to market participants, what they will say, and they'll show you this, that spread differential means of about 1 to 2%, means that the euro should appreciate by 1 or 2% per annum into the future, which means that fair value for the euro-dollar exchange rate when Donald Trump comes to the end of his term is about 125. And we're currently just below 120. There was consternation when we hit 120. So in my mind, 125 it's not a quiet quit of treasuries. It's not sell America. It's in fact the path of least resistance for euro-dollar. And we expect that's what's going to happen. Is the dollar rich or cheap? In nominal terms, if you go back to the 1970s, we're pretty much bang on average in terms of the effective exchange rate. In real terms, the dollar is about 10 points too strong. 10 points. So it's got room to depreciate. Now, when Donald Trump said what he did a few weeks ago, the very next day, Scott Bessent came out on CNBC and said, we maintain the strong dollar policy, the US economy is a strong economy, it'll attract inflows and it'll have a stable currency. That is the mantra that the Treasury has had for quite some time. But we know that there's a bigger backstory here, and it goes back to the so-called Mar-a-Lago Accord, penned by Stephen Murray, who has just stepped down from the Fed to be replaced by Kevin Warsh. And that document, many of you have read this document, it has a template for what we've seen over the past year: tariffs, reciprocal tariffs, payment for security zones, it's all in there. And the other crucial thing that's in there is that dollar reserve status, amazing, has really positive aspects to it from a security context, from a control context. But the negative externality is that it results in a strong dollar, which is detrimental to US manufacturing. I'm not saying I agree or disagree with this. This is what the Mar-a-Lago Accord said. Scott Bessent, why is he relevant here? Well, because the US Treasury controls dollar policy, not the Fed. New York Fed will act on behalf of the US Treasury, but it's the US Treasury in control. So what Scott Bessent says is really important. I think Scott Bessent, as head of Treasury, I'm going to say something here that is a little bit controversial, and that is that we have seen a positive delta with respect to the US fiscal deficit. So we've got a huge fiscal problem here in the US, a huge fiscal deficit. The positive delta is very important. If you remember during the pandemic, when did risk assets rally? They rallied when things began to get less worse. They didn't wait until we got to the worst point. It was when it was becoming less worse. So the delta is really important. So here's two important data points with regards to the fiscal deficit. First one is that the fiscal deficit in fiscal year 2025 was below the fiscal deficit in fiscal year 2024. That's a win. It shouldn't have been. The narrative was that it was going to be above. It's a win. Why? Partly because of the tariffs. The tariffs made that difference. It brought in $120 billion that we didn't have. Second delta, first quarter of 2026 fiscal year, the fiscal deficit has come in $100 billion less than the first quarter in 2025. And this is why when you look at the Treasury market, you look at the rates market, and you're asking yourself, why are things so calm? In fact, that positive delta is a huge help. 10-year Treasuries versus 10-year SOFR. 10-year SOFR is the risk-free rate. 10-year Treasuries is what Scott Bessent has got to pay to get paper into the market. That spread was 65 basis points post-Liberation Day. It's now come all the way back down to 35, 40 basis points. So the US Treasury is still paying an additional 30, 40 basis points to get paper into the marketplace, but it's come down. One positive delta. And the interaction with tariffs here is interesting. To give you a number, we have a fiscal deficit of $2 trillion. Tariffs will bring in comfortably $300 billion. It could be double that, in fact. So it's not nothing. Whether you like the policy or not, it's a tax and it's bringing in revenue. Second, unexpected positive that I want to address is inflation. It's almost a year since Liberation Day. And if I look on my screen, what do I see? I see US inflation 2.6, 2.7, surprising to the downside, only a smidgen away from the long-term average. So why have tariffs not clobbered us in terms of inflation? Well, the simple story here is that corporate America is taking the pain. I think there's two stories here. One, there are inefficiencies in the collection of tariffs. They're actually running at half what they should be. And secondly, like I say, corporate America is taking the pain. But this ability for the corporates to take the pain and for the price increases not to be passed on has allowed the Fed to cut rates. And now we're in a situation where Chair Powell is kind of relaxed. He's looking at inflation, which looks okay. He's looking at inflation expectations, which are tolerable. And then he's looking at the labor market. Now, the labor market is where we have a very complex story to be told. So we got to start off with the most important number that we look at on a monthly basis is the payrolls report. And here we have to execute what I call the Chair Powell algorithm, which is whatever number you see, you take 60K off it. Why? Because we've had benchmark revisions of downwards of 60K typically. So if you look at the payrolls numbers we've had over the past number of months and employ the Chair Powell algorithm, basically employment is flat. We're not generating any jobs here in America at the moment. Why? We're not having enough kids. So demographic issues. And over the past number of years, that's been solved by inward migration. And I don't have to tell this audience what the story is with regards to inward migration. That's being reversed significantly. So we don't have an employment growth narrative out there at the moment. And that's a point of vulnerability, because that can very easily tip into jobs getting shed. Now, my day job is to travel across the US and talk to corporates right across the US. And I still haven't gotten to that point where there's an impression that there's a big layoff to happen. Are we seeing layoffs? Yes, we are. But it's not your typical pre-recession anticipating a big downturn type scenario. We're also not seeing big hiring. So we got this no hire, no fire economy. And it's difficult to imagine this is going to continue. Something's got to give. Either the Fed comes in and cuts rates and things perk up again, or we fall over the cliff edge and the Fed really has to cut. But I'll add something else to this story, two things. First of all, we have the jobless claims. Now, for those of you who look at this on a regular basis, they come out every week. They tell us how many new claimants are coming on to claiming for unemployment benefit. They have been astonishingly firm. So let me give you the number. The last number we had, which is just a week ago, jobless claims were 200K. Now, what does that mean? Well, the historical average is 350K, going back to the 1950s when the economy was half its current size. Ongoing claims, the number of people who've signed on and are still on, 2 million people in the US. Historical average, 3 million people. So 2 million versus 3 million. The unemployment rate, 4.4%. And this is what Chair Powell is looking at. He's looking at a really benign environment with respect to the unemployment rate, a benign environment with respect to inflation, and he's sitting back now and he's waiting to see what his next move might be. So when we look at growth in 2026, and I see you standing there, Nick. I know I've got to shut up. When we look at growth in 2026, we're glass half full. Very reluctant to talk about 2% growth, but very comfortable to talk about 1 point something, and it's 1 point high something. The last number we had was 4%. It doesn't feel we're dipping into a recession. So glass half full is the way that I would characterize it. Now, I realize I haven't answered any of the questions that were posed there. I'm conscious of that. I don't know why I've reminded you of that, but he's standing there.
But maybe we can mix it in. So let me go and stand there with John's question. So, I mean, trade grew by 5%, more or less. Payments grew by 9%. Let's see what the audience thinks about growth for next year, because, I mean, it kind of beat the level of growth that's just been indicated for 2025. If you were looking at 2026, where would you call U.S. GDP? So can we have the polling question up? So the options are above 2.5%, between 1.5 to 2.5, between 0.5 and 1.5, below 0.5, and I'm thinking there's going to be a recession. The polling question up yet? We're claiming another 2 minutes, right? It doesn't seem to reset. Anyway, let's just ask Porek then. Where would you call GDP for next year?
So if we look at GDP aspirations for the US, historically, the accepted idea is that this economy grows by at least 2%, with an aspiration to get to 3%. And we've done better than that. Now, if we look into the future, it's always complex, but it's even more complex now, because if you break growth out into employment growth plus productivity growth, which is the classic way to measure output, employment growth is not great. I mean, normally if you were to tell me that employment is not going to grow, I would tell you, well, it's going to be pretty miserable out there. But on the productivity growth perspective, the numbers we have are not great in terms of their treatment of the entire economy, but productivity growth is quite positive right now. And we are going through a bit of an AI revolution. So I'm kind of optimistic that the productivity growth aspect offsets the very weak employment growth aspect, and we end up with something that's halfway reasonable over the course of 2026. So as I said, 1 point something approaching 2. It's not great, but it's tolerable.
Super. I wanted to get to Andrea's question about the regional view, right? Talk about Africa, talk about Europe, talk about Asia. A big difference between the US and those economies?
Yeah, absolutely. Absolutely. So the US is, at the moment, an island of relative stability, I would say, in terms of macro growth. And what I mean by that is, it might sound like a strange thing to say, but for a long time we've been anticipating a recession. We haven't had a recession, so there's an element of resilience in the US, which absolutely helps Asia. I mean, if I think about Asia, or if I think about LATAM, my starting point is always going to be 3 things. 1, how is the US doing? If it's doing good, that's good. What's the dollar up to? If it's too strong, that's not good. Bit of weakness, good. Good for LATAM, good for Asia. And how are US rates doing? If they're low, good. If they're getting cut, good. So it's all very supportive from an Asian perspective. The biggest issue in Asia right now, and this goes right across the Pan region, is the weakness of the Chinese economy, which remains an ongoing issue for the Asian region, generally speaking. But Asian region is in decent shape. I started out talking about Japan. Japan is back. We had a low inflation number a couple of weeks ago, but what you have is a 2% inflation environment in Japan. Africa is frontier. And this is where there is a very complex mix of influences from the various global powers, the colonial powers mixed with the current global powers. So the colonial powers were the English and the French, and to a certain extent the Dutch. That there's still an element of that in Japan, in Africa. If I talk to Africans from the west part of Africa, the realization has dawned that the French relationship has been beneficial because they tend to ask the French for money, but the French have controlled their economies. Very smart by the French, by the way, to do that. But that's a bit of a lingering issue. And as you go across Africa, it's been supported by Chinese money in many, many cases. So there's a Chinese influence. There's absolutely a Russian influence. And the Americans are, in fact, a bit behind the pace. So very complex, but you would have to be bullish on Africa. It's where you've got the biggest demographic positives into the future in terms of the size of the economy. But as always, corruption remains an issue and has held Africa back. Africa could do with good leadership. It does often feel that as soon as guys get elected in, they forget their morals and they go off and do the wrong thing. So that's missing in Africa.
And some good news from South Africa, right? Finally having some positive growth there. We have, I think, let's close out with one question. Okay, the Federal Reserve Bank. I know that's something that you wanted to address. How do you see the upcoming changes in the Federal Reserve Bank?
So Kevin Walsh is the new chair. I never expected it to be Kevin Hassett because he's too aligned with the Trump administration. So Kevin Walsh is a really interesting hire. What I would watch for very carefully is his ambitions with respect to balance sheet reduction. And what he's saying is that we can cut rates because he believes that the current FOMC are old school and don't understand the productivity advantages that AI brings. And he relates back to when Greenspan cut rates when we had strong productivity growth. So there's this rate-cutting ambition. And at the same time, there's a balance sheet reduction ambition. Now just bear with me for a moment on this. I'm going to describe this as attempting to put the toothpaste back into its container. That's really tough. Because what we're talking about here is, in the best case outcome, to get back to where we were before the GFC. And what I mean by that is before the GFC, we had a single Fed funds rate. It was pretty easy to regulate. There wasn't the big balance that we're looking at now. And it was a very different rate-setting environment with the only reserves that the central bank had were regulatory reserves. And you didn't get remunerated on those reserves. Since the GFC, we've had QE cubed during the pandemic, so the balance sheet has exploded. So the Fed currently holds about $7 trillion worth of government bonds, mortgage-backed bonds, T-bills. And what they've done is they've brought that balance sheet down to a level that it's currently at where there aren't consternations on the repo market. And what they're looking at specifically is bank reserves. That's the counterpart to the excess liquidity that we have in the system. So banks post cash at the Fed, about $3 trillion worth, and the Fed pays $365 to the banks, which is a bit of an eyesore. So what you'd like to do is get that down. And the way the Fed manages rates today is it has a reverse repo rate, a permanent repo rate, floor ceiling, a rate in excess reserves, an effective Fed funds rate, which they attempt to manage using all those three rates. It's really complex, but it's the only way to manage this excess reserves system. So to get from that back to where we were, man, I need to see the plan. because it's quite an ask. The current Fed prefers just to stick with the current setup because it works, rather than attempting to go back to where we were.
I think we're out of time, Porek.
Yes.
Thank you very much, Porek. Isn't it amazing to see somebody so enthusiastic about rates?